Yeah, good afternoon, all the participants uh, on this Union Budget 2025. Uh, I request all the participants to please mute their mic so that everybody can hear the things. And I also request, as and when there is any query, they can either raise their hands or they can type their queries in the chat box itself so that we can address those queries. And all are again requested to mute themselves. I request my team also to mute all the participants. So I, on behalf of Mysuri International Business Foundation, on behalf of Mewar Chamber of Commerce and Industry, Bhilwara, and on behalf of Tax Bar Association, Bhilwara, as well as the Institute of Management Consultants of India, Mumbai, welcome all the participants on this much awaited webinar on the Union Budget 2025. And friends, you all are aware that this Union Budget this time, for the first time, have crossed the budget of 50 lakh rupees, 50 lakh crore of rupees. Uh, Earlier, it was around 47 lakh crore of rupees. I'm sure our speaker of the day on direct taxes, Parwal sir, will also uh, tell us the what are the exact facts and figures related to the Union Budget 2025. Before I introduce both the faculties as well as I invite them for their lecture. In fact, there are 2-3 things which are there in the budget and which may have the long-term implication on the overall uh, economy of the country and various other sectors which are there. So one of the uh, change which they are bringing is the change in the definition of small and medium enterprises. And is this change what they have defined the micro enterprise. Earlier, the micro enterprise limit was investment limit was 1 crore. Now it has been increased to 2.5 crore, and turnover limit of micro enterprise has been increased from 5 crore to rupees 10 crores. Similarly, definition of a small enterprise investment limit of rupees 25 crore is of 10 crore is increased to 25 crore, and the turnover from rupees 50 crore has been increased to 100 crores. And for medium enterprises, their limit has been increased to 25 crore from 10 crore, to 50 crore from 20 crore, and turnover of rupees 250 crore has been increased to 500 crore. So basically, these changes may sound small, but there are a lot of benefits which are being given by the government of India and various other state governments also. So basically, many of the enterprises who are now falling in the micro, small, and medium enterprises definitions will get all those benefits. And probably the enterprise which will be getting these benefits will be doubled as compared to the enterprise which were earlier there. So this is one major change which the government has proposed through union budget. So what I am discussing is about the union budget, and of course the proposals related to the direct taxes and indirect taxes will be discussed by our faculties. The another discussion, the another thing which is there is basically with reference to the insurance sector. Government has allowed that in insurance, earlier it was the 74% limit, FDI limit in the insurance sector. In fact, till 1999, there was FDI in the insurance sector was not allowed. And thereafter, initially in the year 1999, they have allowed the 26% of the FDI limit for insurance companies. Then for last various years, last many years, this was not increased. In 2015, this limit was increased from 26% to 49%. And then in 2021, Modi government again increased it to 74%. And now this limit has been increased to 100%. तो कहने को ये है कि साहब ये केवल एक लिमिट चेंज हुई है, अदरवाइज हेलो कहने को ये लिमिट जो है वो सिंपल एक लिमिट बढ़ी है, बट जो गवर्नमेंट इसमें देख रही है, व्हाट दे आर लुकिंग इज दैट the insurance sector, which is presently in fact not even covered 5% of the entire market. So they want that uh, other companies also come into this particular sector, more investment comes into this sector, so that the entire coverage of the insurance can be there throughout the country. And the companies like multinational companies like Aviva, Zurich, all these companies can also further invest their stake into this, and market also becomes competitive so far as insurance is concerned. So that is the purpose of the government, and probably through this change, there may be a lot of further reduction in the insurance premium prices if suppose some more MNCs come into the insurance business here in our country. And then there are changes related to the, providing the nuclear energy. So here again, the government has allowed that private sector can also, government will allow that the private sector can also basically come into the sector of nuclear energy. And for this purpose, the finance minister has announced the nuclear energy mission for the Viksit Bharat, aimed at developing 100 gigawatt of nuclear energy by 2047 for energy transition. The finance minister also announced that amendments will be made to the Atomic Energy Act 1962 and the Civil Liability for Nuclear Damage Act 2010. This Civil Liability for Nuclear Damage Act 2010, we all know it was in the era of Dr. Manmohan Singh, wherein they have signed one agreement, and that deal was called the deal 123. So an amendment is now required into that particular act also, which is government is proposing, and through which they are proposing that ultimately for private sector can also invest into the nuclear energy. So that is basically for the purpose of providing the clean energy uh, in this power sector, because as of today, if we see the other companies who are particularly in the coal sector, we cannot call it as clean and green energy. So this can be a mission for the government. I request all to please mute themselves. I also request my team also to please mute if anyone is coming, any noise is coming from someone. So friends, these are some of the small, I cannot say small, these are few changes, few proposals which are there in the budget, which may ultimately uh, result in the growth of the economy. There are a lot of other changes also, a lot of other reforms also, but I am not touching much of them. Uh, so I also request our speaker that they will touch with the various facts and figures uh, related to the Union Budget 2025. And before I invite Parwal sir, most of us basically know Parwal sir. Is there into the direct access practice for last around 4 decades, and have regular appearance before the Commissioner Appeals as well as the Income Tax Appellate Tribunal. And when it was there, when Settlement Commission was there, he was also regularly appearing before the Income Tax Appellate Tribunal. And the another speaker which we have is Mr. Saurabh Baser, who has experience of working with Big Four firms also, and presently is practicing at Udaipur. as a chartered accountant. So he is again having more than 10 plus year of experience in the field of indirect taxes. So with this small introduction, I request Parwal sir to please take on through the uh, direct tax proposals, and before that he can just give the related facts and figures uh, of Union Budget 2025. Parwal sir. And I request all the participants to please give your queries in the chat box, or they can raise the hands so that we can invite them for raising the queries personally also. Prakash Parwal sir.
Thank you, Bhupendra, for arranging this budget webinar of decoding the union budget. And I am very glad to see that 4 associations have joined together for this webinar. So first of all, I congratulate the office bearers of Maheshwari International Business Foundation, office bearers of New Mewar Chamber of Commerce, Bhilwara, office bearers of Tax Bar Association, Bhilwara, and office bearers of Institute of Management Consultants of India, Mumbai, to arrange this webinar. And I also invite all the participants in this Union Budget 2025. Now, what I would be doing that I would be sharing a presentation, and through that we would be discussing some important issues which is arising in the direct taxes so far as the budget is concerned. But before that, I may just take to you some of the highlights of this budget. And this is the 8th successive budget which has been presented by Finance Minister Nirmala Sitharaman. And if we go to her budget speech, then 2 aspects which is important to know is that this budget is for speedy development. So in his budget speech, she said that this budget is for speedy development. And second important issue we see raised is that this budget is going to increase the spending capacity of middle income group. And we all know that to achieve this spending capacity of middle income group, changes has been made in the slab rate, in the new regime slab rate, which we would be discussing. Now, one of the points we see made in the budget speech is that we trust the SSC first and then we scrutinize. So the theme word was trust first, scrutinize next. So that is the motto behind the tax assessment, which she said in her budget speech. Now, before coming to the budget proposals as such, let us first look into what are the statistics of this budget. We all make our own budget, but we must know what is the size of the country's budget. So I hope this screen is visible to all of you. So if we look into the facts which is presented in this budget, then one can see that the total size of the budget is 50.65 lakhs crore. And if we compare with the budget for financial year 24-25, which would be just ending after 2 months, the original estimate was 48.2 lakhs crore, which is revised to 47.16 lakhs crore. So this is the size of the budget. So if we compare, then you may appreciate that from 47.16 lakhs crore, the size of budget has increased to 50.65 lakhs crores. So almost 3.4 lakhs crores increase is in the coming year's size of the budget. Now, if we analyze these figures, that what is the revenue of the government and how they are utilizing this receipt. I would not say revenue, because receipt and what is the utilization of that receipt. So in accountancy parlance, we all know that there are two types of receipt. One is a revenue receipt and other is a capital receipt. So revenue receipt we all know, but when the government presents the budget, the capital receipt includes the recovery of loan also and borrowing also. So if the government borrows fund, or if he has given loan and the loan is recovered, so that is also considered as a capital receipt in the budget figures which is presented by the government. So if you look to this slide, then you would see that revenue receipt, which for financial year 24-25 would be 30.88 lakhs crore, that would go up to 34.20 lakhs crore. So almost there would be an increase in the revenue, by more than 3 lakhs crore. Now, the capital receipt from 16.28 lakhs crore, it would be 16.45 lakhs crores. So that is the size of our budget. But how this revenue would be spent? So the first item is effective capital expenditure. Now, for a speedy development, the country requires an infrastructure setup. How much investment is made in increasing the infrastructure facility so that there is growth in the business. So towards the capital expenditure, the increase is almost around 2.3 lakhs crores. From 13.18 lakhs crore, it would be 15.48 lakhs crore towards the capital expenditure. Now, because government is making borrowing also, so a large part of the receipt goes for payment of interest. So interest payment would be 12.76 lakhs crore in fiscal year 25-26. That is the estimate, as compared to 11.38 lakhs crores for this fiscal year. And the third item is revenue expenditure. Now, revenue expenditure is that expenditure which does not give you anything back. And this revenue expenditure is basically the administrative cost of the government. So it would be 22.4 lakhs crore, though it is almost same as compared to this year, which is 22.6 lakhs crore. So this is being tried to be being maintained, that government does not spend, means the spending is not increased so far as revenue expenditure is concerned. So this is how the total breakup of the size of the budget is concerned. And if we look to the last part of this slide, then if we reduce from the revenue receipt the expenditure, then this fiscal deficit. So fiscal deficit is total expenditure minus revenue and capital receipt other than borrowings. So if we take out this figure, then our fiscal deficit would be 15.69 lakhs crores in this year, which is estimated to be 15.68 lakhs crores in the next year. That is, it would be 4.8% of the GDP, which would be reduced to 4.4% of the GDP. So that is how the government has given the estimates for fiscal year 25-26. Now, in the next slide, I have just highlighted that from where this amount would come. We have just seen that our revenue receipt is 34.20 lakhs and capital receipt is 16.44 lakhs. So what is this percentage involvement in these receipt under the various sets? So in revenue receipt, the income tax would contribute 22%. So from in the total size of the budget, because size of budget is 50.6 lakhs, 65 lakhs crore. So contribution by the income tax would be 22%, and corporation tax is 17%. So 22 plus 17, that is 39% is from the direct tax. Now, if we look to the indirect tax, then union excise duty is 5%, GST and other taxes 18%, and custom 4%. So if we aggregate all these three sums, so it would be 27%. So 27% contribution is from indirect tax, 39% share is from direct tax, and then borrowings and other liabilities are to the extent of 24%. And then other miscellaneous and non-tax receipt is around 10%. So this is how the funds would be coming to the government, and how it would be utilized is 20% goes towards the interest payment and 22% goes as state share of the taxes and duties. So whatever direct and indirect tax comes to the coffer of the central government, some of that amount is shared with the states. So states share in the gross revenue receipt, direct and indirect tax receipt is 22%. Interest payment is 20%. Then central sector scheme is 16%, and finance commission and other transfer is 8%. Now towards defense, 8% of our total receipt would go to the defense uh, spending, and then pension is 4%. So this chart shows that how this fund would be utilized. Now, since we are discussing today the direct and indirect taxes issues in this budget, so let us have a look that what is the estimate of direct and indirect tax collection for fiscal year 25-26, and what would be the collection for financial year 24-25. So in direct taxes, the revised estimate for financial year 24-25 is 22.37 lakhs crore. Now this would be up to 25.20 lakhs crores. So almost it is around 2.8 lakhs crores increase as compared to the last year. And this increase is after the revenue foregone by the government to the extent of 1 lakh crore because of the changes in the slab rate under the new regime, which I would be discussing a bit later. So direct taxes here includes both the individual taxes and corporation taxes. So the entire direct taxes collection is estimated to be 25.2 lakhs crores. Now, if we add up custom, excise, service tax, and GST all together, so it would be around 17.5 lakhs crore. So 25.2 lakhs crore is from direct taxes, and around 17.5 lakhs crore would be from indirect taxes, which would include excise, custom, service tax, and the GST. CGST, basically it would be CGST, which goes to the state. So 11.78 lakhs is the CGST GST collection as compared to 10.62 lakhs in the financial year 24-25. This is the estimate which has been given. So that way the total revenue would be 42.7.
पहले अप्रूव हो गई, आप लोग में आ गई, अब रिजेक्ट कर देंगे तो ये अब वो वापस नहीं हो सकती, नहीं चाहिए होता नहीं हो सकता।
Please mute
sir,
your
म्यूट करेंगे रुचिन जी।
इसमें क्या आपको कुछ लोग चीटिंग कर रहे हैं, अपन ईमान से कर रहे हैं।
कर दिया सर,
So,
I have done.
this is the total size of the budget. Now coming to the direct tax proposals, which has been mentioned in the finance bill, the first change is, and which is much talked about, when this before this bill was presented, then most of the persons were saying that at least the basic exemption limit should be increased to 10 lakhs of rupees. But to the surprise of everyone, the rates has been so moderated that up to 12 lakhs of rupees, there would not be any tax. Other than this, there is no changes in the tax rates. And this tax rate, which is given, is the new tax regime rate. Presently, in the income tax, there are two rates. One is old regime tax, and second is new regime tax rates. Now, this tax rate is for individual HUF, AOP, BOI, and artificial judicial person. So this is for basically individual and HUFs that this rate would be applicable. Now, presently, if one go to the old rates, then old rates are basically the basic exemption is only of 2.5 lakhs crores. If you want to have a look to the present rate, so old rate is up to 2.50 lakhs, there is no tax. Then 2.5 to 5 lakhs, the tax rate is 5%. From 5 lakhs to 10 lakhs, it is 20%. Exceeding 10 lakhs, it is 30%. So this is the old tax rate, which is also prevalent. One has the option to choose for old rate, but that if you choose the old rate, then you are eligible for various deduction of chapter 6A, like deduction under section 80C. That is, if you make an investment in PPF, NSS, or life insurance premium, or Mediclaim, or ATL, the interest and all those deductions are available. But from last 4 years, a new tax rate is also incorporated in the statute, whereby you would not be eligible for any deduction under chapter 6A, that is for investment, but tax rate has been reduced in the new rate. And this new rate is now the default rate, meaning thereby, if you want to opt for the old regime rate, then you have to opt specifically while filing the return of income. Otherwise, automatically by default, it will be assumed that you want to file your return by applying the new rates. So the new rate for financial year 24-25, for which we would be filing return by July or August, September, October, as the case may be, the present rate is that up to 3 lakhs, there is no tax. 3 lakhs to 7 lakhs, the rate is 5%. 7 to 10 lakhs, it is 10%. 10 to 12 lakhs, it is 15%. 10 to 12 lakhs is 15%. 12 to 15 is 20%. And exceeding 15 lakhs, it is 30%. This is the present rate. And there is a tax rebate under section 87A, where tax rebate was allowable up to the maximum of 25,000 of rupees. So presently, if we take advantage of these rates and 87A benefit, so up to 7 lakhs of rupees, there is no tax. How 7 lakhs it is no tax? Because from 3 lakhs to 4 lakhs means 3 lakhs to 7 lakhs, that is on 4 lakhs. The tax is 5%. So it was only on 4 lakhs, 5% is 20,000 rupees. So thereby you are getting rebate under section 87A. So up to 7 lakhs, there was no tax. But now these rates has been modified in such a manner that one of the factor which has been mentioned by the FM in her budget speech is to increase the spending capacity of the middle income group. So to do that, what has been done is that up to 4 lakhs, there is no tax. And then in multiple of 4 lakhs rupees, the tax rate is multiplied in the multiple of 5. So if you look to this chart, from 4 lakhs to 8 lakhs, that is on the next 4 lakhs of rupees, the rate would be 5%. Then from 8 lakhs to 12 lakhs, that is another 4 lakhs increase, it would be 10%. Then 12 lakhs to 16 lakhs, again 4 lakhs increase, the rate would be 15%. 16 to 20 lakhs rupees, it would be 20%. And a new slab has been introduced of 25%, which is 20 lakhs to 24 lakhs, it would be 25%. And above 24 lakhs, it is 30%. So it has been so, the rates has been so changed, coupled with 87A benefit, which provides 100% tax rebate. And that tax rebate has now been increased to rupees 60,000, or up to the income of rupees 12 lakhs, there would be tax rebate, whichever is lower. So up to 12 lakhs, now no tax is payable. But this is available only for those who are in the new regime of taxation. And this is a default scheme, meaning thereby that unless and until you opt for the old scheme, your tax would be calculated by this new tax regime rates. Now, the effect of this is that each household, if there are 4 members in a family who are filing the income tax return, say ranging from 8 lakhs to 12 lakhs of rupees, so each individual would be getting a benefit of around 70,000 to 1 lakh of rupees. So in each household, there would be a tax saving of around 3 to 4 lakhs if 4 members are filing the return ranging from 8 to 12 lakhs of rupees. So that is how the spending capacity of middle income group is going to be increased. So with this saving, they can plan whether they are to save by making investment somewhere, whether they want to spend it. If they want to spend it, it would come in the economy. And when you spend it, also there would be some GST may be involved. So again, government may get some revenue by way of indirect taxes. So this is how the spending capacity of middle income group is proposed to be increased through changes in the slab rate in the new taxation regime. And in this new taxation regime, there would not be allowed any deduction except for 3 deductions. First is, if you are a salaried employee, then standard deduction of 75,000 would be given. So for a salaried class, if he has an income of 12.75 lakhs, so 75,000 would be given by way of standard deduction. The gross total income would be 12 lakhs on which no tax would be payable, considering rebate of 87A. So this is available even in the new regime standard deduction. Secondly, if you have a family pension income, then a deduction of 1/3 of such income or 25,000, whichever is lower, that would be allowed under this new scheme also. Then deduction of the amount paid or deposited in Agniveer Corpus Fund under section 115 BAC would also be allowed as deduction. And employees' contribution to NPS under section 80 CCD2, that would also be allowed as a deduction in computing the total income under the new tax regime. And on that income, the slab rate would be available. So these are the changes which has been proposed. And because of these changes, the revenue foregone by the central government is estimated to be 1 lakh crores of rupees. So this is what has been specified in the budget speech by the FM. Now above 50 lakhs, we have seen that up to 24 lakhs, the rate is above 24 lakhs, rate is 30%, but there is no surcharge. But if your income increases 50 lakhs, but it is less than 1 crore, then surcharge is 10%. If it is above 1 crore but less than 2 crores, it would be 15%. And if it is above 2 crores, the surcharge would be 25%. But if you opt for the old scheme, then above rupees 2 crores, the surcharge would be 37%. So almost this old scheme would not be opted by anyone. This new scheme rates has been made so lucrative that most of the, I would say 99% would opt for now new scheme, unless and until there is some thing which gives an benefit in the old scheme. And this all would be increased by a surcharge of 4%, a cess of 4%. So this is how the tax rate has been moderated. Now there is no change in other rates. In cooperative society, there is no change. In domestic company, there is no change. So there is no change in these rates. So this is the most important change which has been made in this finance bill. And even you must have seen some videos that when this proposal was tabled by the finance minister in the parliament, then the treasury benches were thumping their tables, but the entire opposition was very shocked to see that instead of 10 lakhs which they were demanding the tax rate benefit, no tax rate benefit has been given up to the income of 12 lakhs. So that is even beyond their imagination and expectation, that the slab rate would be so moderated that up to 12 lakhs of rupees there would not be any tax. Now coming to the direct tax proposals. Now I have bifurcated into 5-6 parts. The first is with reference to individual taxation, that what are the important changes in the individual tax rates. So the first change which is proposed to be made is in section 17. Now section 17 deals with taxation of salary income, and in this section, if you receive any perquisite from your employer, then certain conditions are mentioned, that these would be the conditions for availing, means when a perquisite would become taxable. So according to the existing provision, perquisite include the value of any benefit which is granted free of cost or a concessional rate by an employer to an employee whose income under the head salary as a monetary benefit does not exceed rupees 50,000. So there is a limit mentioned here of 15,000. And similarly, if an employer gives or reimburse the expenditure on the medical treatment of an employer or any member of the employee's family, so that would not be included in perquisite, but the condition was that it would not exceed rupees 2 lakhs of rupees. So presently the statute itself provide a limit of 50,000 and 2 lakhs rupees, as the case may be, under these two clauses. Now what is proposed to be amended is that instead of mentioning it in the statute, it is proposed that the government would make rules that to what extent it would be considered as a perquisite, or to what extent the travel made outside India on medical treatment would not be treated as perquisite. So instead of incorporating in the statute itself, the power has been taken by CBDT to prescribe the rules. So because of these rules, it would be easier to increase the amount which they want to allow as not perquisite for the purpose of medical treatment, or to the extent when you provide any benefit or concessional rate or any free of cost benefit, then the monetary benefit under the head salary, which was not to be exceed by 50,000, that power has been taken by the CBDT by prescribing the rules. So this is the first amendment in the individual category. Now the second amendment is with reference to deduction under section 80CCD for contribution made to NPS Vatsalya. Now this would be effective from 1st April 26, meaning thereby it would be applicable for assessment year 26-27. Now this benefit is proposed to be extended with reference to the proposal is that this deduction would be allowed to parent of the guardian's total income of the amount paid or deposited in the account of any minor under the NPS to the maximum of 50,000 overall. This is the amount which would be allowed as a deduction to the parent of the guardian, maximum up to 50,000. When this amount is withdrawn, then it would be liable for taxation. And when the account is closed due to the death of the minor children, then it would not be deemed as income of the parent and guardian. So what is provided is that if you contribute to NPS, then up to 50,000, the parent of the guardian would be allowed as deduction. But when the amount is withdrawn, it would be subject to tax. But if the minor dies, then on closure of that account, the income would not be charged to tax in the hands of parents of the guardian. So this is what has been proposed to be amended. And a new clause 12BA is incorporated in section 10 to provide that any income which is received on partial withdrawal made out of the minor's account shall not be included in the total income of parents and guardian to the extent it does not exceed 25% of the amount of contribution made by him and in accordance with the terms and conditions specified under the Pension Fund Regulatory and Development Authority. So to the extent of 25% of withdrawal, it would not be subject to tax. That is what has been proposed in this clause. Now in 80 CCA, now this is almost a cosmetic change, and because this NSS scheme, National Savings Scheme, this has been omitted from 1st of April 1992. So this scheme of investment in NSS was up to 31st March 1992. After that, this scheme has been discontinued. But if there is any fund lying in that account, then if you now withdraw that amount, then it would not be subject to tax. Earlier, whatever you withdraw from the NSS account, it was subjected to tax. But now it is proposed that withdrawal made from the NSS account on or after 29th of August 2024 would not be subjected to tax. So this is the amendment made in this clause. Now, this is one amendment which has been liberalized. Presently, if you have more than one house, then if that house is not giving you any yield, then even if it is lying vacant, then it was chargeable to tax on a notional value. Now, an amendment was made previously that if you are holding two houses and both these houses are your self-occupied house, but the second house, which is a self-occupied house, is due to the requirement of your employment, then annual value of second house would also be considered as nil. But that condition was because of your employment, you are forced to have one more house at some other place where you are employed. So that was the condition. Now that condition has now been removed. So any person, any individual, any person who is having two houses, which is used by him as his self-occupied house, then the notional value would not be subject to tax in respect of that second house. So now two houses, this benefit of nil tax is available in respect of two houses without any condition. So a person may have two houses at Jaipur or at Kolkata or at Mumbai or at whatever place he is residing. Maybe that is required because of during the course of his employment or otherwise. So in both the situation, without any condition, there would not be any notional taxation under the head income from house property in respect of two self-occupied houses. So this is the amendment which has been made in this section. And this is applicable from 1st of April 2025. Means for the current year also you can take this benefit. Now there are some amendment under the heads business and capital gain taxation. So first change is in section 80 IC, which provides tax benefit of 100% tax benefit for 3 years out of the 10 years to a startup. So this startup has to be incorporated by way of a company, company, and the period of incorporation was between 1st of April 2016 to 1st of April 2025. So now this has been extended for 5 more years. So now any startup which is incorporated till 1st of April 2023, they would be eligible for this benefit of section 80 IC, which is 100% tax benefit for 3 years out of the 10 years. So that limit has been increased to another 5 years. Now there is now a new requirement of furnishing information of transaction of crypto asset. Now there is a section in the Income Tax Act 285BAA where certain institutions are required to furnish the information in relation to their customers. Already there is means a section 285BA. Now this new section has been incorporated, which is section 285BAA. And according to this section, now the prescribed reporting entity has to furnish information in respect of transaction of crypto asset in a statement within the time and manner which would be prescribed by the tax authorities. And those persons who are dealing or providing these cryptocurrency transactions, they would be required to be registered with the income tax authorities, and all these authorities would be required to furnish the information in respect of their clients in this statement. And on the basis of this information, the transaction which has been made by a person in cryptocurrency would be reflected in his AIR information.
Parval sir, you are mute for last some time. For around 1 minute.
Now voice is coming.
Yes, sir. Yes, sir.
Yeah, just I was just sharing the amendment which is made with reference to furnishing of information in relation to crypto transaction. So crypto transaction information has to be furnished by the prescribed reporting entity. They have to be get themselves registered with the tax authorities, and based on that, this information will be reflected in the income tax portal of those persons who have dealt in cryptocurrency, and on the basis of that, they should take care to file their return, including the income which is generated from the cryptocurrency. And crypto asset is also defined by inserting a new clause D to section 247A, that what the cryptocurrency would mean. So that is now also defined in, specifically defined in section 247A by inserting clause D. Then there were some issues or debate with reference to the carry forward of losses pursuant to amalgamations. So when there is an entity which was suffering losses and that company got amalgamated with some other company, then the issue was raised whether the period of 8 years which is allowed for carry forward and set off of accumulated losses whether that limit would be counted from the date of amalgamation of another 8 years, or it would be counted from the date when the amalgamating company incurred the losses and claimed carry forward. So now it is made specifically clear that any loss forming part of accumulated loss which is merged with any other entity, that so the new entity, the successor entity, would be eligible to carry forward that loss for not more than 8 years as the amalgamating company could have carried forward. So suppose for 4 years the amalgamating company was there and it was carrying out the carry forward losses, and then it gets amalgamated. So successor entity would be eligible for carry forward for another 4 years only, and not for 8 years. So that is now made very specifically, and this amendment is made effective from 1/4/2025. Means for this assessment year 25-26 also, one has to take care that whenever there is an amalgamation, then successor entity would be eligible to carry forward the losses for the balance year only, and not for the 8 years of its own. So that amendment has been now made. Now this is also one amendment which we must all take note of. Now presently what is provided in the Act is that there is a due date for filing income tax return. Generally for individual and HUF who don't have any business income, or entity who don't have any business income, so they are to file their return of income by 31st of July. Now, if you have business income which is required to be, accounts are required to be audited, then the due date of filing of return is 31st of October. But if you have a transfer pricing issue, if there is international transaction and there is a transfer pricing issue, then due date is 30th of September. So that is the due date. If you are not able to file return by the due date, then there is a provision for filing a belated return, or if there is a mistake or omission in the return which you have filed by the due date, then there is a provision for filing a revised return. So that is up to 31st of December. Earlier it was 1 year from the end of the relevant assessment year, so one was getting time up to more than 18 months. Now this time limit has been curtailed, and with curtailing this time limit, a new concept of updated return was introduced 2 years back. Now presently this updated return can be filed, but the condition for an updated return is that you cannot claim a refund in updated return. You have to pay some tax in the updated return. That is the requirement. So presently what is provided is that you can file updated return up to 24 months from the end of the assessment year. So for example, your assessment year is say 22-23 assessment year. So 22-23 assessment year, you can file updated return up to 2 years from the end of the assessment year, that is 31st of March 2025. And there were two rates prescribed. One is that if you file updated return within 12 months from the end of the relevant assessment year, then whatever tax and interest you are paying, additionally on that you are to pay 25% extra. And if you are updating your return after 12 months, but up to 24 months of the end of the relevant assessment year, then you are to pay additional 50% of the aggregate of tax and interest. So that is the present position. Now what is proposed is that 24 months is now extended to 48 months. So up to 4 years from the end of the relevant assessment year, you are given an option to file a updated return if you find anything which has been omitted to be included in the return which you have filed, or if you have failed to file a return of income. So both the situation, you are eligible to file the updated return up to 4 years, up to 48 months from the end of the relevant assessment year. So the first two slab of 25% and 50%. So if you are filing updated return within 12 months from the end of the relevant assessment year, you are to pay 25% extra. If it is within 24 months, then you are to pay 50% extra. If it is between 24 months to 36 months, then you are to pay 60% extra. So whatever additional tax and interest you are paying in the updated return, you are to pay additional 60% of that tax and interest. And if you are filing the return after 36 months, but up to 48 months of the end of the relevant assessment year, then you are to pay 70% of the aggregate of the tax and interest. So one may raise a question that then why after 4 years one would file a return? Now there is a reservation here also, and that reservation is that if your any action of 148 has been taken by the department, a notice of 148 has been issued after 36 months, then you would not be eligible for file any updated return. So up to 36 months, even if you have received a notice under section so-called notice under section 148A, and if you see that yes, that income ought to have been included, then you can still update your return. You would be saved from the penalties which would be imposed if you don't update your return. And what you have to pay extra is 70% of the tax and interest. Means 60% of tax and interest if it is between 24 months to 36 months. So this is a welcome provision for those persons who have not declared any income in their return of income, which is already filed. It comes subsequently to their notice. And as of now, a number of notices has come to the various individuals who have given political donations. So one can analyze, because presently it is 2 years from the end of the relevant assessment year. So up to 2 years, the department has issued notice to number of persons who have given political donation claiming 100% deduction. So if they feel that yes, this claim may not be allowed to them, they can still file an updated return by paying additional 50% of tax and interest, which otherwise was payable by them. So one can take benefit of this process. If you don't pay this, and then you have still an option, because this amendment would be applicable from 1st of April 2025, but then rate would be increased to 60%. So this is the changes in the updated return. Now then, whatever penalties are imposed under section 270 capital A or 271(1)(c) or 271(d)(e), there are a number of penalty provisions. So presently there were different time limit provided for levy of penalty. In 275, there are 3 clauses: clause A, clause B, and clause C. So those limits were there that within this period you are to impose the penalty, otherwise it would be barred by limitation. Now that clause has now been rationalized by providing that no order imposing penalty shall be passed after expiry of 6 months from the end of the quarter in which the proceeding in course of which action for imposition of penalty have been initiated or completed, if the assessment or other order is not subject matter of an appeal. So first is that if an assessment has been made, then and you have not filed an appeal against that assessment order, then presently the time limit for deciding that penalty was within that financial year in which the assessment order is passed, or within 6 months from the end of the financial year in which that order was passed, whichever period is later. That was the present position. Now what is provided is this would be 6 months from the end of the quarter in which that assessment order is passed. So if assessment order is passed in December 20 4 or say January 25, then quarter would end on 31st of March 25. So 6-month period would be available up to 30th of September for passing the penalty order if the appeal is not filed. But if his appeal is filed, then whenever the appeal is decided, either by the CIT appeal or by the ITAT, so it would be 6 months from the end of the quarter in which the order of ITAT is received by the PCIT, or whenever the order of CIT appeal is received by the judicial PCIT or CIT, as the case may be. So now whatever penalties are imposable, even if there is a default of section 269 SS or 269T, meaning thereby there is an acceptance of cash loan exceeding rupees 20,000 rupees or repayment of cash loan exceeding rupees 20,000 rupees. So penalty is impossible. So all those would be governed by this clause now within 6 months from the end of the quarter in which the penalty proceedings are initiated or when the assessment is completed, as the case may be. So this is the amendment in section 275. Now some changes is made in the definition of capital asset, not very much relevant to, not very much relevant. And the amendment is that any security held by investment fund referred into section 115 UB, which has invested in such securities in accordance with the regulation made under the SEBI Act 1992, would be treated as a capital asset only, so that any income arising from transfer of such security would be in the nature of capital gain. So the dispute whether it would be a business income or it would be a capital gain, that is now blocked by making amendment in section 214. So any security which is held by the investment fund, that would be subjected to the capital gain taxation only. This is what has been provided. Another amendment is made in section 1010D. Now this section provides that if you are making any premium of a life insurance policy, so if your premium does not exceed 10% of the sum assured, then whatever you receive at the time of maturity of life insurance policy, that would not be subject to tax. It would be exempt under section 1010D. Now, if your premium is more than 10% of the sum assured, then whatever amount you receive, that is subject, not exempt as such, it would be subjected to tax that has been provided. Now, presently, there are certain policies which is one-time policy or term policy. If you are making investment in unit-linked insurance policies, then already there is a provision which says that income to the extent of 2.5 lakhs of rupees would be exempt there. But if it is a life insurance policy, term life insurance policy, then that exemption is not available. So what is now proposed is that the unit-linked insurance policy and the life-linked insurance policy, unit-linked insurance policy, they are being made at par. So what is proposed that the ULIP for which section 1010D does not apply would be considered as a capital asset. So whatever you receive by making investment in a term life policy, so whatever income you get, suppose you have invested say 1 crore rupees in a term life insurance policy and you receive 1 crore 50 lakhs, then the differential 50 lakhs which hitherto was subjected to tax would be subjected to tax as a capital asset. It would be considered as a capital asset. So the tax rate applicable would be 12.5% on if it is a long-term capital asset. So if you have hold the unit linked policy for more than 3 years, after 3 years you get a return, so it would be subjected to long-term capital gain or short-term capital gain, as the case may be. and not as income from other sources. So this is what is changed in section 1010. The read with section 214 also there is the changes made there. Now then there are certain amendment which is made in the TDS and TCS provision, and these changes are basically to rationalize the various limit which is provided in various sections relating to the deduction of tax at source. So quickly we can go to this chart. Now in section 193, there is a requirement of deduction of tax at source when any person make payment of interest on the securities. So if a company has issued certain debentures, and on that debentures interest is payable by the company to resident individual and HUF, then there was a requirement to deduct tax at source if the amount exceed rupees 5,000 of rupees. Now this 5,000 limit has been increased to 10,000. So, and it is introduced for all assessees, hitherto for individual and HUF. If it was exceeding 5,000 rupees, then TDS liability was there. Other than individual and HUF, there was no basic exemption limit. Now, the limit is increased to 10,000 rupees for all the assessees. So, the companies who have raised the fund by issuing debentures or any other securities, class of securities, so interest payment thereon would not be subject to TDS if the amount of interest is up to rupees 10,000. Similarly, for dividend, this limit was hitherto 5,000. No TDS requirement was there if the amount of dividend does not exceed 5,000 rupees. Now this limit is increased to 10,000 rupees. Now interest other than interest on securities. Now this interest other than interest on securities. So if you have made investment in FDR or to private individuals, you have given loan to those persons, then presently what is the position is that normal, if it is in excess of 5,000 rupees, interest payment is more than 5,000 rupees, then there is a liability of deduction of tax at source. But if any banking institutions make payment of interest to a senior citizen, then the amount was threshold limit for non-deduction was 50,000, and in other cases it was 40,000, where the payer is a bank, cooperative society, and post office. Now this limit has now been increased from 50,000 for senior citizen. It is now increased to 1 lakh for senior citizen. From 40,000 in case of other person where payer is bank, cooperative society, and post office, it is increased to 50,000, and the basic 5,000 has been increased to 10,000. So this non-deduction of tax at source on interest payment has, to some extent, it has been rationalized. And these all are applicable from the current financial year because it is made effective from 1/4/25. Then similarly, this income in respect of unit of mutual fund or specified company or undertaking, the current threshold of 5,000 has been increased to 10,000. 194B and 194BB, that is winning from lottery, crossword puzzles, and winning from horse races. Presently, it is the aggregate amount exceeding 10,000 during a financial year. So if a person has won a lottery of say 5,000 and again 5,000 and again 5,000, so all three amounts were to be clubbed. So it was exceeding 10,000 because 5,000, 5,000, 5,000, 15,000. So there was a liability to deduct tax at source. Now it has been aligned with a single transaction. Instead of aggregating the transaction, now it is made with reference to a single transaction. So if in single transaction you have earned a crossword puzzle of rupees say 7,500, again in the second crossword puzzle you again won 7,500, then both were not aggregated, would not be aggregated. since single transaction is less than 10,000, so for both the transaction, there would not be any tax liability. Now for insurance commission, the limit has been increased from 15,000 to 20,000 for TDS purpose. And income by way of commission, prizes, etc. on lottery tickets. So there also it has been increased from 15,000 to 20,000. Commission and brokerage also 15,000 has been increased to 20,000. But one welcome change is in respect of rent. So presently it is 2,40,000 during the financial year. So if any person is making payment of rent exceeding rupees 2,40,000 during a financial year, then it was subjected to TDS. Now this has been changed to 50,000 per month. So one has to take care that from financial year 2,40,000, it is now 50,000 per month. It is 6,000 per annum, but the limit has to be seen with reference to 50,000 per month. So if you have taken a premises on rent for say in the month of December, and the aggregate for the 3 months, January, February and March is 1,50,000. In the current provision, there would not be liability of TDS, but in the new provision, because it is 50,000 per month, it would be subjected to TDS because the amount is 50,000 per month. Though up to 6 lakh of rupees in a financial year, there would not be any TDS liability. But once it is 6 lakh 1,000 or 6 lakh 10,000, then on the entire amount, TDS would be applicable. So up to 6 lakh, no TDS, but it has to be seen with reference to each month. So 50,001 means there would be a liability of TDS, though aggregate is less than 6 lakh. Now fees for professional and technical services, the limit has been increased from 30,000 to 50,000. Income in respect of unit 5,000 to 10,000. Income by way of enhanced compensation. So that has been increased from 2.50 lakhs to 5 lakhs of rupees. And under section 194 LBC. So TDS of 25% for individual and HUF and 30% for others, where income is payable by a securitization trust to a resident investor in respect of an investment in securitization trust. So all those rates has been clubbed to 10% for all the assets. So in this category of deduction of tax at source, the rate has been reduced to 10% for all the assets. Now then there are certain amendment in section 206C, that is collection of tax at source. So in collection of tax at source, the first amendment is in relation to the profit and gains from the business of trading in alcoholic liquor, forest produce and scrap. Presently, the TCS rate for timber obtained under the forest lease is 2.5%, and timber obtained by any mode other than under a forest lease is 2.5%. Now this is being reduced to 2%, and the slight amendment is that timber of or any other forest produce. Earlier it was timber obtained under forest lease, now timber or any other forest produce. And what is forest produce is also defined to mean the forest produce as defined in the under the Indian Forest Act 1927, or if there is a state act, then what is defined there, that would be considered as a forest produce. So timber or any other forest produce other than tendu leaves is now reduced from 2.5% to 2%, and timber obtained by any other mode other than under a forest produce, it is 2%. So even if you acquire a timber from one dealer to another dealer, it is obtained by a mode other than under a forest lease, then also there would be a TCS of 2%. Now another change in collection of tax at source is with reference to remittances which is made abroad. So under the LRS scheme, if you make any remittance, presently if it exceeds 7 lakhs of rupees, then TCS is collected by the authorized banker or authorized person, authorized dealer at the rate of 20%. Now, this limit of 7 lakhs has been increased to 10 lakhs of rupees. This is one change. Secondly, if the remittance is for the education and medical purpose, then the TCS rate was 0.5% in excess of rupees 7 lakhs. Now it is provided that there would not be any TCS if the remittance is out of the loan obtained from financial institution for educational purpose. So if you have obtained a loan for educational purpose and whatever amount you remit, there would not be any TCS. Earlier, if it was exceeding rupees 7 lakhs of rupees, then there was a TCS of 0.5%. So that has been streamlined. And presently, there are provision for collection of tax at source on sale of goods. And there is also a TDS provision for deduction of tax at source on purchase of goods. So both these sections were somewhere overlapping and were causing confusion that when TCS would be applicable and when TDS would be applicable, though there is already a provision under the TDS that if this section is 194 Q, that if TDS is collected at source, then TCS would not apply. But there were some conditions involved there. So now everything has been removed and now it is provided that 206C1H would not be applicable in relation to sale of goods. So this is a welcome change that now there would be no TCS on sale of goods, only there would be a TDS on purchase of goods. Similarly, there is a provision that if you are not having a permanent account number, then TDS and TCS is at a higher rate. But there is another section that you are holding a PAN number, but you are not filing return in the previous 2 years. If you have not filed return in any of the previous 2 years, then there was a higher TDS rate of 20%. Now that section has been abolished. So now you are not look into whether that person has filed the return or not. If they have not filed the return, you are not to bother. If they are having the PAN number, then there would be a normal rate of TDS. But if you are not holding that PAN number, then already there is a section of higher TDS. But this section which says that if they are holding a PAN number, but they are also not filing the return, then there would be a still higher rate. That section has now been removed. So 206AB in section 206 CCA, one is for TDS and another for TCS. Both sections has been removed. So this is a welcome change. Now with reference to international taxation, there are certain changes. Now the first good change is presently if there is any transaction, international transaction, then one is to then the assessing officer is required to refer the matter to the transfer pricing officer to determine the arm's length price. And if the same transaction is repeated in each year, then the AO was obliged to refer for each assessment year. Now, what is now provided is that if there is similar transaction in the first year, also in the second year, and also in the third year, then you can exercise an option that whatever ALP is determined in relation to that specific transaction, either an international transaction or a domestic transaction, that would continue to apply for the next 2 years. And if the transactions are of similar nature, then once an ALP has been determined by the transfer pricing officer for that transaction in the first year, the same would ALP would apply for the next 2 years, and the AO would not be required to refer for arm's length determination of that transaction in the subsequent 2 years. And whatever adjustment has been proposed in the first year, that adjustment would remain for the another 2 years if you give your acceptance. So you have to exercise your option, but if you don't exercise your option, then it would be referred each year. So this is what has been provided, and it is also clarified that CBDT would issue guidelines to resolve difficulties for implementation of this provision. And based on and one more amendment which is provided is that AO will have to recompute the total income based on the TPO's determination of ALP within 3 months from the end of the month in which the assessment is completed or 143(1)(a) intimation is received. So even if there is a subsequent transfer pricing order, then a period of 3 months has been given to recompute the income if you exercise the option. Now this 115VP, this is in relation to the tonnage tax. So I have not dealt with any tonnage tax assessment, but what is now provided is that presently an option is given to get this assessment of on the basis of the total tons which a ship can take. On that basis, some tonnage tax is there, and this commissioner has get a time of 1 month from the end in which the application was received to pass the order approving or rejection the option exercised by the qualifying company. So if one go to exercise this tonnage tax scheme, and if it is approved, then if it is not approved, then 1 month time was allowed to pass the order. Now this 1 month period has been extended to 3 months from the end of the quarter in which such application was received. So that change has been made. Now a clarification has been made with reference to significant economic presence in section 9. Now section 9 says that transaction or activities that are confined to the purchase of goods in India are not deemed to accrue or arise in India. But in explanation to that clause, there is a issue that when a person would be considered as not having a significant economic presence. So there was some dichotomy between the two clauses. So now it is provided that wherever there is an activity that are confined to purchase of goods in India for the purpose of export, that would not constitute a significant economic presence in India. Now a new presumptive scheme is being introduced by way of section 44(BB)(D), and this would be for computing profit and gains of non-residents engaged in the business of providing services or technology for setting up an electronics manufacturing or in connection with manufacturing or producing electronic goods, article or thing in India. So only applicable to the non-residents. The services should be for setting of an electronic manufacturing or in connection thereto, service or technology for setting up of electronic manufacturing industries, and this person may go for presumptive taxation of 25% of the amount paid or received by the non-resident or any other person that would be deemed to be an income under the head profit and gains of business and profession. So whatever services you are providing, whatever you receive, 25% if you pay under the presumptive taxation, then that would be accepted. Then there is a rationalization of capital gain on transfer of capital asset by non-resident. Now there is a section 115 AD, and this section provides that where the total income of a specified fund or foreign FII includes income received in respect of securities or income by way of long-term or short-term capital gain from transfer of securities, then the tax rate is 10% by way of long-term capital gain. Now that has now been increased to 12.5%, because in all other sections of section 112A, now the long-term capital gain rate is 12.5%. So this is also been aligned with the normal capital gain tax rate of 12.5% instead of 10%, which is provided in 115 AD of the Act. Now there are few changes in the trust related amendment also. Now this trust provisions are itself a very complex provision, and there is a section 12 AB which provides for registration of a trust and institution. Then clause 4 of this section also provide that if there is some specified violation, then your registration can be cancelled. And once your registration is cancelled, then there is a section 115TD which says that the fair market value of your all asset less the liabilities, the difference would be called as an accredited income, and that accredited income would be subject to maximum marginal rate of taxation. So in section 12 AB4, there are number of specified violation, and one of the specified violation is that if your form is incomplete or the form which you have filed for re-registration or getting another renewal of registration, if it contain any false or incorrect information, then it would be considered that there is a violation and your registration can be cancelled by the PCIT or CIT as the case may be. Now, what has been proposed to be amended is that this incomplete form or any false or incorrect information in that form is now considered to be a minor default, and this would not result into cancellation of registration. So that clause G of section 12 AB4, that has now been removed from the specified violation. So this is the first amendment. The second amendment is, presently, once a registration is granted, then this registration is effective for 5 years. For a permanent registration and for a provisional registration, it is for 3 years. And after expiry of these 3 years or 5 years, as the case may be, you are to again move an application for renewal or getting your permanent registration. Now, what is now proposed to be amended is that this validity period of 5 years, that is to be increased to 10 years for small trust. So what is that small trust? The small trust is that trust or institution whose total income or receipt in the 2 previous preceding year does not exceed rupees 5 lakhs of crores of rupees. तो 5 लाख करोड़ से यदि ट्रस्ट की इनकम पिछले 2 सालों में उससे एक्सीड नहीं कर रही है, then the renewal would now be for 10 years. So if you are already registered or already given a registration for 5 years, that would not automatically get increased to 10 years. After 5 years, you are to move an application for renewal of registration. The second time registration would be 10 years, provided your income or receipt of the immediate 2 previous preceding year do not exceed 5 crores of rupees. So this is a welcome amendment. Then there is one rationalization provision also. Presently, if you give any benefit to a specified person, then if it is unreasonable, then you are not eligible for exemption under section 11 and 12. तो यदि किसी व्यक्ति ने, किसी भी ट्रस्ट ने स्पेसिफाइड पर्सन को कोई बेनिफिट दिया जो कि अनरीजनेबल है, एक्सेसिव है, तो उसका ट्रस्ट का जो सेक्शन 11 का एग्जम्पशन है वो विड्रॉ उस साल के लिए हो जा रहा था. नाउ वन ऑफ द कंडीशन ऑफ सेक्शन 13(3) is that a person would be considered as a specified person if he has given a donation or contribution to that trust of rupees 50,000 or more. And not only that person would be covered as a specified person, his relative would also be considered as a specified person, and any concern in which that person has a substantial interest, he would also be considered as a specified person. तो ये बहुत एक लंबी लिस्ट हो जाती थी और 50,000 रुपए का अभी तक किसने डोनेशन दे दिया उसको चेक करना बड़ा डिफिकल्ट था, क्योंकि किसी ने 5 साल पहले 5,000 रुपए दे दिए, फिर उसने 3 साल पहले और 15,000 रुपए दे दिए, ऐसे करके उसका 50,000 का क्वांटम हो गया या नहीं हुआ ये बहुत डिफिकल्ट था, बिकॉज इट वाज अप टू द एंड ऑफ द रिलेवेंट प्रीवियस ईयर. आपको आज तक जितना भी डोनेशन उसने दिया वो सबकी टोटल लगा के देखनी पड़ती थी. Now this has been amended, and the amendment is that you are to check whether total contribution during the previous year exceed rupees 1 lakh or 1 lakh rupees or not, and the aggregate exceed rupees 10 lakhs or not. तो यदि किसी व्यक्ति ने आपको 50,000 का डोनेशन दिया है और उसका एग्रीगेट डोनेशन 10 लाख से ज्यादा नहीं हो रहा है टिल दैट ईयर, then he would not be considered as a specified person. तो दोनों कंडीशन आपको देखनी है कि ड्यूरिंग द प्रीवियस ईयर उसका जो कंट्रीब्यूशन या डोनेशन है वो 1 लाख से ज्यादा नहीं होना चाहिए, और एग्रीगेट जो डोनेशन है वो 10 लाख से ज्यादा नहीं होना चाहिए. यदि ये दोनों कंडीशन फुलफिल नहीं हो रही है तो वो स्पेसिफाइड पर्सन की कैटेगरी में नहीं आएगा, और यदि वो स्पेसिफाइड पर्सन की कैटेगरी में आ रहा है तो उसके जो रिलेटिव है वो स्पेसिफाइड कैटेगरी में नहीं आएंगे, और कोई भी कंसर्न जिसमें उसका सब्सटेंशियल इंटरेस्ट है, he would also be not considered as a specified person. तो इसका जो दायरा है उसको रेस्ट्रिक्ट कर दिया टू दैट इंडिविजुअल ओनली and not extending to the relatives or the concern in which such individual has a substantial interest. So this is a welcome move. Now there are some changes with reference to search and seizure amendment. I would quickly go through because these are only some changes to remove any confusion. Now the first change is presently a definition of undisclosed income is there. Last year there is a concept has introduced of a block assessment. This block assessment is search cases. It would be only for search cases, would be for 5 years. So for 5 years you are to file one single return including whatever you have already disclosed in your return of income and whatever undisclosed income is deducted in course of search. So in the definition of undisclosed income, virtual digital asset is now also included. So if you have any income from a virtual digital asset and that income is not disclosed and that comes to surface during course of search, that would also be considered as an undisclosed income. So that has been made more specifically clear. Similarly, there was certain confusion because the language, present language is that total income was considered to be an undisclosed income. So what is clarified is that income would not be considered as undisclosed income. Whatever is further deducted would be considered as undisclosed income. Then there is a provision that if a search is initiated and any proceedings were pending during that period of time, already it has commenced, then all those proceedings would abate and that would merged with the search proceeding that was provided. So there were certain words not included there, recomputation or reference or order. So that has been included to make it more aligned. So these are some of the changes in relation to the block assessment concept. Nothing means important to discuss here. So considering the time, I am not elaborating it. Some timelines has been made more clear for the period of completion of assessment and all that. So it was now 12 months from the end of the month in which the last of authorization of search was executed. So it has been made more aligned. Now, this is one important, not important, it is a cosmetic change. In case of search assessment, after search assessment, the penalty is imposed under section 271 AA-B. But now a new concept has come of the block assessment. So this 271 AA-B is amendment has been made that this section would apply only in relation to those search cases which is on and before 1st September 2024. After 1st September 2024, this section would not be applicable. So just a clarificatory amendment. Now these 132 and 132B, they are also for rationalizing a provision. अभी कोई सर्च का जो assessment होता था, तो आपकी जो भी बुक्स ऑफ अकाउंट्स और डॉक्यूमेंट सीज किए हुए हैं वो डिपार्टमेंट के पास में रहती थी. एंड आफ्टर कंप्लीशन ऑफ योर असेसमेंट, if the department want to retain those books of account, then he has to take a permission within 30 days from the date of assessment or reassessment. Now this has been amendment that the AO can take a permission for retention within 1 month from the end of the quarter in which the assessment or reassessment has been made. So the time limit has been increased for the AO to seek permission for retention of books of account and other documents. Similarly, in 132B, an amendment has been made to make it aligned with section 1, this block assessment. So that has been a small amendment. So some other amendments which are of relevance in relation to the prosecution issues. Last year, it was provided that if you have not deducted tax at source within the prescribed time, but before the filing of the quarterly return of that quarter, if you have deducted tax at source and paid to the government treasury, then you would not be prosecuted for that default. Though the claim was that this time limit should be extended up to the due date of filing of return, but that was restricted at the quarter. Now that was not available for TCS default, so that has been now incorporated that this benefit TCS also. Now presently various penalties are being imposed by the Joint Commissioner of Income Tax. So penalty for violation of section 269 SS, 269 T, 269 ST. So deduction of tax at source, collection of tax at source, these are being imposed by the additional commissioner or joint commissioner. Now what is proposed is that this would now be imposed by the assessing officer, but it would be subject to the prior approval of joint commissioner. So the power to impose penalty under this section is now delegated to the assessing officer. Instead of at present, it was for the joint commissioner that has been delegated, but approval of joint commissioner would be required. Now 270 AA. 270 AA is a section which says that if AO has made any additions in your assessment, and that is on account of unreporting of income, not misreporting of income, that is for under reporting of income, then you can move an application to the AO accepting that addition, and by not filing the appeal against that addition, if you move an application, then AO within 1 month from the end of the month in which you move the application, in which the order was passed, he can waive the penalty initiation. So that that immunity was granted not to impose the penalty or prosecution if that application is moved. Now this 1 month period for passing the order within 1 month from the end of the month in which the application is received, that is now increased to 3 months. So within 3 months, the assessing officer can take a decision whether your application is to be accepted or not to be accepted. Now there were certain sections which were proposed to be made faceless by the department, and these are the sections under which it was proposed that there would be a faceless assessment or faceless proceeding, and the period for deciding it was fixed by 31st of March 2025. Now what is amended is that instead of mentioning that it would be decided by 31st March 2025, now the power has been taken by the central government that they can issue the direction for making these proceedings faceless by prescribing by the time which they may notify. So the power to notify these dates has been taken by the government, central government, in their hand instead of putting it as a part of the statute. So under these sections, the faceless proceedings provision can be notified by the government even after 31st March 2025. Presently, a person is considered to be an assessee in default for failure to collect TCS after he has to pass an order for constituting an assessee as a person in default within 6 years from the end of the previous year in which the tax was collectible, or 2 years from the end of the financial year in which the correction statement is delivered, whichever is later. Now this limit has been further increased by saying that if there is a stay proceeding in between, then the period from the commencement of the order granting the stay and till the certified copy of the order vacating the stay is received by the principal CIT, that would also be omitted. So that time has now been increased from the date of order to the date of receipt of certified copy of the order vacating the stay by the principal CIT. So that limit has been increased to that extent. And in all these sections, similar provision has been made saying that whenever there is a stay by the court, then till the certified copy is received by the principal commissioner, that period would be excluded for counting the limitation period for doing action under these sections. So certain provision has been made in respect of international financial service centers, and I have mentioned in these slides that what those amendments are. But looking to the time constraint, I am not taking it one by one. But what has been provided is that all those limitation has been liberalized or extended either till from 25 to 31st March 2030. So those changes has been made. Now, one amendment has been made with MSME classification, with Bhupendraji has already told in his initial remark. So these are the limit increased. The effect of this increase in limit is with reference to section 43B of the Act. Now we all know that if the payment is not made to these as MSME within the time prescribed under the MSME Act, then it would not be allowed as a deductible expenditure in that year. Whenever you make the payment in that year, it would be allowed as a deduction. Now, with the increase in the limit, more persons would be falling under the macro and small enterprises. So 43B scope would get enlarged. So that is the effect of this change in the investment and turnover limit, because as number of these persons increases under macro and small medium enterprises, your disallowance under 43B, chances of disallowance under that section would also increase. So one has to take care of this change in the limit with reference to the income tax provisions. And finally, the finance minister promised that she would introduce a new simplified income tax bill in the next week. So this week would close on Saturday. So by Saturday, we can expect that a new income tax bill would come to surface. The purpose of this new bill is to increase tax certainty, reduce litigation, focus on justice, and achieve more good governance. What is clarified that the new bill will be clear and direct in tax. It would be half of the present law, both in terms of chapter and words. It would be simple to understand for taxpayer and tax administration, and it would lead to tax certainty and reduce litigation. So these are the objectives which has been given in this new tax bill. We eagerly wait for this new bill to see that how clearly this act is drafted, or this bill is drafted, and still it would be a bill. So if there is any suggestion from any quarter, so one can give those suggestions, so this bill really become effective and reduce the tax. So friends, with this, I conclude my topic on direct taxes, and thank you all of you for giving me this century. Thank you. Over to Bhupendra.
Over to Bhupen. Over to Bhupen. Over to Bhupen. Yeah. Thank you, sir. Thank you so much. So, in fact, since we have already exceeded the time and we have our speaker Saurabh Basir with us from Udaipur, he is again a seasoned professional and into the practice for more than 10 years in direct taxation. So I straight away request Saurabh Basirji to please let us know about the indirect tax proposals first, and then I will take up the queries directly from the participants, whichever queries are there. So, Saurabh, to you.
Thank you, Upendraji. I think the screen is visible. Yeah. So
yes.
Fortunately, we don't have that much of amendments in indirect tax, specifically in GST, thanks to GST Council. What has happened is all those recommendations which Council has made in last 2-3 meetings, they have now taken it into consideration for legislative framework. So I'll quickly go to the GST proposals. Yeah. So first is issuance of credit notes. So what they have proposed is in section 34, wherein a registered supplier has to issue. I think there is some. Hello. Hello.
Yeah, 1 minute. I will just.
I think that's fine now.
Yes, Saurabh, you can start with you.
Yeah. So section 34 provides a mechanism to the supplier by way of issuance of credit note. He can reduce his tax liability. Whatever he has declared in his invoice, he can reduce by way of a credit note. Now, what they have proposed is for each such credit note, the supplier, before reducing his output tax liability, he has to ensure that the recipient has already reversed that ITC, which he has availed in the original invoice. So I'll just take an example. Suppose as a supplier, I've issued an invoice of say 10 lakh rupees and I I have paid the tax at 18%, amounting to 1,80,000 on that particular supply. Now my recipient has also taken credit of that 1,80,000. In future, if there is any sales return or any excess tax payment or any other reason by which I have to reduce my tax liability, I have to issue a credit note. Now, as per this particular provision, if I issue a credit note of say 1 lakh, right? So I need to ensure that my recipient has also correspondingly reduced his input tax credit by 18,000. So this is a logical amendment, given that whatever has not been paid to the government account, input tax credit cannot be taken for that particular tax amount. Now the challenge is how to implement this whole process. As a supplier, how can I ensure that my recipient is also reversed that particular input tax credit? So there is no online mechanism as on date which allow me to check whether my recipient has taken that credit note into his consideration or he has reduced that credit amount. So in a way, they have again put that restriction or any non-compliance on part of my recipient will have to be borne by me as a supplier. Previously, this condition was also there, but that was only restricted in case of post-sale discounts, that any discount which I'm offering after completion of my supply, that was only required where the recipient is required to reverse the credit. In those cases, CBIC issued a circular number 212, wherein they were provided that a CA certificate or a CMA certificate can be obtained from the recipient certifying that he has reduced his input tax credit. But this circular was only related to post-supply discounts. Now, with this particular change, where each and every credit note has to be seen whether the recipient has reversed his credit or not, getting this CA certificate or any other mechanism, that will be a challenge and will be additional compliance for the suppliers. So this is on the part of credit notes. Again, much talked about amendment regarding blocking of credit on immovable properties. So I'll just go by the provision which is existing as on date in section 17(5)(d) of CGST Act. It provides that where a taxable person is constructing any immovable property on his own account, the input tax credit of all the goods and services used in that construction activity of immovable property is not allowed. Only exception was if that construction is for plant or machinery, right? So the term plant or machinery is not defined anywhere in the law, right? There is one particular definition in section 17 only, which provides the definition of plant and machinery. So difference is or and end. So they have defined plant and machinery, but the term which was used in section 17(5)(d), which ideally disallows me input tax credit for construction of immovable property, the term used was plant or machinery. Now they have came up with this amendment and they have explained that this was a drafting error and this has to be read as plant and machinery only. Now what does this mean? So in case we see the definition of plant and machinery, that specifically excludes land, building, and other civil structures. So they have gone back and retrospectively changed this terminology plant or machinery with plant and machinery and clarified that this disallowance of input tax credit for construction of immovable property, that is applicable from 1st of July 2017, that is retrospectively, and any construction activity of immovable property, the ITC related to such goods or services shall not be allowed to the recipient. Right? Now, what is the judicial history behind this particular amendment? So, in case of safari retreats, the Odisha High Court held that so that case was related to a immovable property where the assessee contended that I am constructing a particular building and I'll be giving that building on rental, right? So on those rental charges or that lease income, I'll be paying GST. So in that case, if my output is taxable and GST is liable on my output service, why I am disallowed for taking input on my inward side, which is construction activity of constructing that whole premises. To me, that particular premises is a plant, right? Because before this particular case, this particular term plant or machinery was referred. So they contended that my building itself is a plant for me, and that input tax credit for construction of that particular building shall be allowed, right? So Odisha High Court passed a favorable ruling and they allowed the input tax credit. Now the revenue challenged that particular decision before Supreme Court, and last year the Supreme Court held that yes, the term plant or machinery and the term which is defined in the section plant and machinery, both are two different terms, right? So plant and machinery provides an exclusion for land, building and other civil structure, but the term which is used in section 17(5)(d), which is plant or machinery, that is not same as plant and machinery. And they remanded back matter to the High Court and directed to allow ITC if the building meets the functionality test criteria. So in a way, this was seen as a respite by all the people who are engaged in construction activities or into rental activities, right? Now in 55th GST Council meeting, the council recommended that this has to be retrospectively amended and section 17(5)(d) to be amended, and this term or should be replaced with and, right? And this is irrespective of any ruling or any court order. This retrospective amendment is proposed in the Finance Bill 2025. So this amendment overrides all these rulings and order of Supreme Court, and the status quo is again maintained that this particular credit is not allowed in case anyone is engaged in construction of immobile property on his own account, irrespective it is part of my plant or machinery or not, right? So just to add to this one, since there are multiple legislations, one is at the central level, which is CGST Act, and every state have their specific state GST Acts. Interestingly, in Rajasthan State GST Act, from day one, they have already used the word plant and machinery. Now, if you'll see multiple states, they have their own legislature in terms of GST. And normally you will see a copied version or same version of Act which has been defined in CGST Act. But in Rajasthan State GST Act, they have since inception, that is from July 1, 2017, they have used the term plant and machinery only. So there is no such change for people who are already working in Rajasthan or dealing with this matter. So this amendment is in a way not impacting them, right? Another point which is important to be made is there are more than 8 retrospective amendments since rollout of GST in 2017, right? And including this particular ruling, there were another retrospective amendment which was carried out, and a Supreme Court decision was overturned, that too retrospectively. So when we talk about tax legislation certainty or any stability, that becomes a pertinent question at this point, that after 8 years of rolling out of the tax legislation, we are giving the excuses that this was a drafting error and that has to be read as, a plant and machinery and not plant or machinery. That raises a question on the legislation also. So that is one part in terms of safari retreats ruling, which has now been overturned with this particular amendment. Another important amendment is on the pre-deposit criteria for filing appeals. So if you'll see this table, for filing appeal before first appellate authority under section 107, as of now, in case there is a demand for tax, interest and penalty, the appellant was expected to deposit only 10% of tax amount as a pre-deposit for filing appeal before appellate authority. Now they have kept that particular provision as same, that in case there is a demand for tax, interest and penalty, only 10% pre-deposit has to be made. There was another provision for detention, seizure of goods and other irregular related cases, where demand was only for penalty. In those particular cases, the pre-deposit was 25% of the penalty amount. They have reduced it to 10% in this particular amendment. However, in all other cases where there was no requirement of pre-deposit, where the demand was only for penalty, they have brought in a new provision wherein 10% of penalty amount is to be deposited before filing appeal before the appellate authority. So in a way, in case there is demand of only penalty in your order or the order in original by adjudicating authority, you are now required to pay 10% of penalty amount as pre-deposit in all cases, irrespective of it is related to e-way bill or any other case. So 10% pre-deposit is a mandatory criteria going forward. Similarly, in the appeal before appellate tribunal, you are required to pay 10% additional penalty as pre-deposit if the demand only pertains to penalty. It looks like a very, very small change, but just looking at the practical ramifications, so I have just extracted a adjudication order where a director of a company, which was alleged as evading taxes, he was charged with a penalty of 71 crores. Similarly, in the same matter, the tax head of that particular company was also imposed or confirmed a penalty of 71 crores. Now imagine with this particular provision kicking in on the terms of pre-deposit, where 10% pre-deposit is mandatory. How about these individuals who are now required to pay 10% pre-deposit as and when they are challenging their penalty notices or penalty orders before the appellate authority? So this is something which will impact the cash flow for the taxpayers as well as all those persons who are not even registered. So this director or this authorized person who is working as an employee in the company is not even registered. But since the department has levied a penalty on that particular individual, he has to either contest or pay this penalty amount. If he has to contest, he has to pay 10% of this amount as pre-deposit. So this is for those individuals who are not registered and are merely part of that dispute just because of their official capacity. This is going to hurt them badly. And I would urge MCCI and other industry bodies to please ensure that this is made part of the budget, post-budget memorandum, that this pre-deposit amount shall be restricted only to registered taxpayers, so that any individual who is part of any dispute, he is not liable to make any pre-deposit, at least in non-evasion cases. So this is one important amendment which needs to be taken care of. Another small specific amendment regarding SEZs and FTWZs. So any supply of goods by way of transfer of title, while the goods are warehoused in SEZ or FTWZ, that is not considered as supply of goods or services. So this is again a retrospective amendment and a welcome amendment, but they have also clarified that in case anyone who has paid the tax, considering this transfer of title of goods while the goods are being warehoused, if anyone has paid the tax, there will be no refund allowed. So whatever has been done in past, that has to be accepted. There is no refund for that particular amount of warehouse goods. But going forward, this is not considered as a supply of goods or services. So this is specifically for units in SEZs or FTWZs. There are other proposals wherein they have changed the definition of local authority, and also the definition of input service distributor has been expanded to include ITC distribution for both intra-state and interstate transactions. So these are all clarificatory amendments. A new track and trace mechanism has been introduced, and this is for notified goods. There is no available list as of now that what all goods will be covered, but goods like tobacco and other sin products where the possibility of tax evasion is high, this mechanism will be introduced for those particular commodities. The council has already clarified that the vouchers are not subject to GST, and accordingly time of supply provisions which were there in the law as on date, those particular time of supply provisions for vouchers are now omitted. Again, in October, invoice management system was rolled out on GST portal. So they have provided a legal framework to that invoice management system by amending the relevant sections, and also to restrict filing of 3B unless GSTR 2B is available on the portal. So these are specific changes which provide a legal framework to invoice management system, which is already there on the GST portal. Again, on the customs front, the settlement commission has been abolished for excise as well as customs effective April 1, 2025. And they have also provided that all the pending cases which are pending before settlement commission as on date, they will be referred to an interim board for disposal. Time limit for finalization of provisional assessment. So there was no definitive time limit for provisional assessments in case of customs. It was there by way of education guide or circulars, but in law itself, there was no definitive timelines. Now they have proposed a timeline of 2 years, which is further extendable up to 1 year for finalization of provisional assessment. So this is again a welcome proposal. Next is again a taxpayer-friendly proposal where importers or exporters will be allowed to self-correct their errors, whatever they have reported in bill of entry or shipping bill within a prescribed period. Right. So even after clearance of goods for export or import, you'll be allowed to revise your bill of entry or shipping bill, and you can correct the errors if any, even after clearance of goods. But this is subject to some limitations, like in case of search and seizure, these provisions are not applicable. On the part of customs duty, they have rationalized duty structure again with that Make in India theme, and only one cess or surcharge on imports by proposing exemption from SWS, that is social welfare surcharge, or cess. So only one cess or surcharge will be applicable, which means that your effective duty structure will remain same. There will be no change in effective duty of customs. They have rationalized the duty structure. That's it. So that's all from the indirect tax point of view. I think in case there are any questions, we can take up the same.
Yeah, thank you, Saurabh. So we shall first take, I think there is one question related to direct tax. If Ajay Soniji is hearing, he can just raise it because it is not yet clear. He's saying that what is the meaning of MNCT for filing of the return, meaning 4 lakhs or 2.5 lakh. Maybe that he is not available right now.
What is
any
the
other
query?
For direct, sir, it is what is the meaning of MANCT for NCT?
MANCT.
For, I think, filing of return, meaning 4 lakh or 2.5 lakh. So if Ajay can explain if he is available.
MANCT, what is it?
Any other query on direct taxes? One can raise the hands and unmute themselves. So probably most of the queries, most of the provisions have been explained in a lucid manner by Paral sir, and there are some limited amendments only in the direct taxes as well as the direct taxes. The another query, Saurabh, is from you, that is regarding this.
So on the
for
input
GST,
side,
now whether
I think
aluminum structure type set which is being fixed with nut bolt to earth can get input tax credit.
So, sir, this is again a very subjective issue. We have litigation in past. So only criteria which is there now is whether that is part of your plant and machinery or your production cycle or not. I think that is the safest criteria which is there, because they have included the term any other civil structure also. So if this particular aluminum structure which you are talking about, if you can link it with your production process and consider it as a part of plant and machinery, I think you can reasonably take a position that credit is allowed. In any other case, if it is part of any other immovable structure, I doubt that this will be litigated by the department.
Okay. So any other query
This
for GST or
Bhupendra, this
yes, sir?
MANCT means maximum amount not chargeable to tax. This is the meaning of MANCT. So a new word has been defined, maximum amount not chargeable to tax. So 2.5 lakhs is for the old regime and 4 lakhs is for the new regime.
Okay.
The question I think is whether 2.5 lakhs is the limit or 4 lakhs is the limit for the maximum amount not chargeable to tax. The limit for 2.50 lakhs is one who opts for the old regime of taxation, and 4 lakhs is for the new regime of taxation. Means those who opt for the new scheme, which is a default scheme, there the maximum amount not chargeable to tax would be 4 lakhs of rupees.
Yeah, got it, sir. So I think we have already crossed the 6 p.m. time, which was supposed to be the closing time for this webinar. With this, I thank both of our speakers, Parwal sir as well as Saurabh Basir, for their insights into the Union Budget 2025 and particularly related to the direct taxes and indirect taxes. On behalf of all the four organizations, that is Mysore International Business Foundation, Mewar Institute of Mewar Chamber of Commerce and Industry, and Tax Bar Association of Bhilwara, as well as Institute of Management Consultant of India. So thank you everyone for your participations as well as patience listening of the subject by both the speakers from the workplace.
Thank you.
Thank you so much.
Thank you. Thank you.
Thank you.
Sir, looking to our relationship.
Thank you, Bhupenji. It was a wonderful webinar. Is it available over the YouTube or recording is available? Are you there, Bhupenji? Hello.